Welcome to Stress-Free Investing Analysis Personal Notes. I am absolutely thrilled to have you here today. Look, in this explainer, we're taking a serious deep dive into Berger Paints India Limited. It's kind of fascinating right now because you've got this 100-year-old titan, totally zero debt, but it's standing at a massively critical inflection point. So we're going to unpack exactly what's brewing beneath the surface. But first, just take a quick second to read the SEBI disclaimer up on your screen. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. Basically, this explainer is just for educational purposes, all right? Okay, let's dive into this. Here is our roadmap for today. First, we'll look at the Berger Paints business moat, then financial health and growth trends, followed by the emerging competitive threat. After that, we'll weigh the bull versus bear case, check out key catalysts to watch, and wrap it up with the final verdict and summary. Section 1. The Berger Paints business moat, a 100-year-old titan with powerful distribution. All right, so to really understand where Berger's headed, you've got to grasp the sheer scale and legacy of India's second-largest paints company. Look at how they actually make their money today. A massive 70% of their revenue comes straight from decorative paints. You know, the interior and exterior paints people buy for their homes. Industrial paints make up about 16%, while higher growth stuff like construction chemicals accounts for 8%, and their international subsidiaries bring in the last 6%. The big, absolutely crucial takeaway here, Berger's fortunes are heavily, and I mean heavily, tied to the consumer decorative market. And in that specific market, they've built a moat that is just incredibly wide. They command roughly a 26% market share in decorative paints, cementing them as a really solid number 2, right behind Asian paints. But get a load of this distribution network. We're talking over 1,800 company-owned stores and more than 125,000 dealers spread across India. You combine that insane reach with brand equity that's been compounding since 1923, plus management's proven ability to just consistently keep EBITDA margins between 15 and 17%, well, you end up with structural advantages that a new competitor literally cannot replicate overnight. Moving on to Section 2, Financial Health and Growth Trends, the volume-value disconnect. Now, what's really interesting about this slide is that despite that massive moat we just talked about, their recent financials are showing a pretty fascinating trend. The shift from FY24 to FY25 highlights the striking divergence between how much paint they're actually moving and how much money they're making off of it. I mean, while FY24 showed phenomenal recovery, just look at FY25. Revenue crawled up by only 3.1%, and profit after tax, or PAT, basically stalled entirely. It grew a mere 1.1% to 1,180 crore. For compounding growth stock, you guys know a 1% profit growth is a major red flag that definitely warrants our attention. But hey, before we hit the panic button, we've got to look at the balance sheet because despite that slowing growth, Berger's is sitting on a jaw-dropping 918 crore rupees in net cash as of December 2025. And to top it off, their long-term debt is effectively zero. Zero! That is a rock-solid balance sheet, giving them the financial firepower to weather almost any storm. So let's see how this builds into the core problem they are facing right now, the volume-value gap. In Q3 of FY26, Berger's actual paint volume grew by a really healthy 8.5%, but their 9-month FY26 PAT, it actually dropped by 13.8%. How is that even possible, right? Well, consumers shifted heavily toward lower-margin economy products, and the company had to maintain earlier price cuts just to stay competitive. Basically, they're selling more buckets of paint, but making less money on every single bucket. Which brings us to Section 3, the emerging competitive threat, the 10,000 core elephant in the room. So you might be wondering, why were those price cuts even necessary in the first place? Well, we have to talk about the massive structural change altering the entire Indian paints sector. That threat is perfectly quantified by this one number, 10,000 crore rupees. That is the massive capacity expansion and market entry capital unleashed by Grasim's Birla Opus. Backed by a giant conglomerate balance sheet, they've entered the market aggressively, throwing massive dealer incentives around to secure shelf space. It's incredibly rare to see a new entrant arrive with this level of funding and immediate scale, and it is putting immense pressure on Berger to defend its turf. And let me tell you, the smart money has definitely noticed. Just look at the steady decline in foreign institutional investor, or FII, shareholding here. From 5.75% in March 2025, it's ticked down sequentially to 5.25% by December. This persistent institutional selling is almost certainly driven by this new competitive reality and heavily influenced by things like Morgan Stanley's multi-year de-rating thesis on the Indian paint sector. Basically, institutions are de-risking. Section 4. The bull versus bear case. Two conflicting futures. So, with this epic clash between a 100-year legacy and well-funded new competition, we're looking at two highly conflicting futures for Berger paints. The absolute crucial point here is that both scenarios hinge entirely on pricing power. In the bull case, recent price hikes hold, double-digit volume growth actually translates to the bottom line, and FY27 profit jumps to 1,600 crore. But in the bear case, Grasim's aggressive dealer incentives force Berger to roll those prices right back. Value growth stays flat, margins compress, and FY27 profit stagnates or even drops to 1,050 crore. It's practically a binary outcome based entirely on whether they can successfully charge a premium for their paint. Section 5. Key catalysts to watch. The April inflection point. Now, the good news is we don't have to wait years to see which case is playing out. The inflection point is literally happening right now. On April 9, 2026, Berger implemented a 5 to 10% price hike, which was triggered by rising crude and titanium dioxide costs. And crucially, market leader Asian Paints simultaneously hiked their prices by 6 to 8%. Guys, this is the ultimate test of pricing power. Will the consumer accept it? Well, we are going to get our very first piece of hard data on this today. May 12, 2026 is the Q4 FY26 board meeting and earnings report. The numbers they drop today will tell us for sure if that value-volume gap is finally starting to close. Section 6, Final Verdict and Summary, Analyzing the Risk-Reward. All right, let's bring all this data together and actually analyze the risk-reward ratio at current market levels. First up, valuation. Berger's current trailing 12-month PE ratio sits at roughly 45.4 times. What does that mean in plain English? It means the market is already pricing in a significant earnings recovery. Investors are paying a premium today for profits they expect tomorrow. And because that multiple is so elevated, your margin of safety is pretty slim if that recovery gets delayed. Let's actually walk through the math here. At the current price of roughly 468 rupees, the base case, where the price hike only partially sticks, offers a solid 24% upside over 2 to 3 years. The bull case, that offers a massive 60% upside. However, if the price hike fails to hold and the bear case plays out, we're looking at a 19% downside, taking it to around 380 rupees. So while the upside is highly attractive, it completely 100% hinges on those April price hikes sticking in the face of Grasim's onslaught. And this brilliantly illustrates why my current personal stance is a patient hold or watch. It's simply too risky to bet heavily before seeing the Q4 numbers dropping today. If the stock does dip toward that 380 to 420 rupee level, it becomes a much safer accumulation zone. But right now, patience is the ultimate strategy. So will Berger's 100-year legacy and massive moat withstand a 10,000 crore disruption, or is the Indian paint sector forever changed? We will soon find out. Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video. Thank you for watching, and keep your investing stress-free investing.